Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thank you very much for tuning in this week, and thank you very much each and every week that you comment on what we're doing. And we get a number of different comments depending on what we do and what particular format and I guess outlet that we're using. We're on, we've got a blog, we've got a bunch of radio shows that we do. We're certainly on podcasts as well as social media, whether it's LinkedIn or Facebook or Instagram. I had some 200 comments on my blog the other day. Now, my blog is not necessarily industry related. It's more a way by which I can just blow off steam to the world. So do appreciate all of that. And again, this is Jeff Barton, and we are the Mortgage Voice. The 8 podcasts that we're on, Daryl, you got all 8 of them there?
I do. I'm going to go backwards this time. YouTube, radio.com, iHeartMedia, Stitcher, Spreaker, Spotify, Google Music Play. They're also global. And
yes, they are.
Apple Podcast.
Excellent. I know that YouTube, our YouTube channel, Jeff Barton, the Mortgage Voice, we get a lot of hits on that. We put both shows on that. I like YouTube. YouTube is a great place to showcase what we're doing here, which is to bring information about mortgages, about what's happening in the economy to affect the rates, how the programs are expanding or contracting depending on what's going on. In my other show today, we talked some about how the different administrations handle housing. We had Ben Carson at HUD. I don't know who the HUD person is today. Treasury secretaries have changed. Janet Yellen is in now, and Steve Mnuchin is out. I don't think that Treasury is going to change that much, but we will have some coordinated efforts between the old head of the Fed and the new head of the Fed, which is, of course, Jerome Powell, has been in there for a couple of years now. And that's a good thing. I think continuity in financing, in the financial, the way that we deal with things is good. And so having both of these ex-Fed and current Fed working together closely to try to bring relief to people in the mortgage industry, and not the mortgage industry, but who has a mortgage and who have a rent issue, is a good thing. We've seen first day of the new president, he's extended the moratorium on foreclosures and mortgages and evictions in rents to September, I think, of next year. I think that's a good thing, and that's a good time. I think in September of next year, we're talking third quarter of 2021. I've heard all kinds of projections. And by the way, we get our information on the internet just like everybody else. We just know some better places to go, right? Housing Wire is a great place to get information. Mortgage News Daily, which I always hype, is another good place. And certainly in Housing Wire, you get live podcasting as well as written materials. A lot of this information in today's shows came from them. So let's get right to what we're trying to talk about today, which is first thing we'll talk about are the rates and what's happening in the rate. The rates themselves have gone up. They're not at their historic lows, although they're pretty close. We think the rates are going to increase this year. Now, we've said this in the past. Last year at this time, I said that rates would probably go up to 4.5. Well, obviously the pandemic hit. The Fed started buying treasuries and started buying mortgage-backed securities to the tune of the combined $120 billion a month. Artificial holding down the rates. It wasn't necessarily the 10-year that was affecting rates. It was mostly that, there was a ready-made market, so there's no need to raise the rates because you don't have to attract buyers. We've seen a little bit different focus on rates as a result of the outside forces affecting them. Therefore, we've seen the actual 10-year Treasury note increase, although not much, but still, we're above 1% yield, which is, where we usually would see a rate hike if we see the 10-year go up, and that is what's happened. So the 30-year fixed rate is at 2.84. See, come on, these rates are still smoking. So if anybody's out there worried about rising rates, these are still great rates. 2.39 for the 15, 2.38 for FHA, 3.33 for the jumbo, and 2.32 for the 5/1 ARM. 5/1 ARM is a good product if you're in short term. Obviously, the jumbo is still a great product. Now, each lender is going to have their own overlays or their own way that they calculate risk, and the risk is higher. It's going to charge you more in terms of interest rate. These are for the best and most pristine borrowers out there, 800 FICO plus, 20% down if it's a purchase, or if it's not, then there are other mitigating circumstances that would affect rate, whether it's, something, a ding in your credit score or some kind of income issue. We had a loan that came through today that the investor was actually Rocket Mortgage, asked us for some additional documentation about what happened to the employment during COVID. Well, a lot of companies laid people off early on during COVID. This person works in the hotels out in Vegas, and for, I don't know, I guess a couple, 3 months last year, the person was out of work. And so they had to verify that the dates were correct and that the person was back to work, and that the interruption didn't really disqualify them for the loan, but they want to make sure that that's exactly what happened, as opposed to the person taking time off for other reasons or getting fired and then rehired. So yeah, that's an issue now. It's going to be an issue going forward. I think further we get away from the huge shutdown, although right now we're having some issues too. And we're also going to see, as a result of the pipeline being shut down yesterday, a lot of layoffs in that industry. That regardless of what you think environmentally, that was a big employer. And seeing in that part of the world that those particular people get laid off, as well as, in the shale oil business, that hasn't been doing so great either, because the demand for oil is really down, has been down quite substantially. Daryl, did you see what the reduction in carbon emissions was last year for the U.S.? It's an astounding number, really.
It was incredible, and everybody pays attention. And then, unfortunately, because of what's going on with the COVID and the deaths, they had to increase the number of cremations that the mortuaries can do, because it adds to
carbon
issues. Yeah.
Well, it went down to 12%, and I didn't know that about. That's an ugly word, cremation, and the pandemic is awful, and having an administration in there now is 100% focused on that, getting everybody shots. That's a good thing. I'm a 65-year-old guy. And I called my doctor today to say, well, what do I do? I mean, if you're out there, and this is a PSA, if you're out there and you're wondering about what to do, those are the people to call. I mean, you can go on the county health sites and try to look up where to go and what to do and how to sign up. I know many people have tried to do exactly that, but have been lost in line and disconnected, websites crashing. Yeah, it's kind of a mess right now.
So you're in LA or Ventura County?
This is in Los Angeles County for those people who are not in Los Angeles County, whether you're in Albuquerque or up in Tahoe or in Las Vegas, in your particular area, as well as the Inland Empire, of course, it's going to be different, right? Everybody's going to have their own issues. But from what I understand nationally, it's a mess everywhere.
Yeah, they've got stuff on the television every night about what LA County residents can do, but here in Ventura, we've heard nothing.
Yeah, it's the bastard stepchild syndrome, right? I mean, Ventura County, which is an amazing place and a great place to live, always seems to take it on the chin, because LA County, dwarfs them in size. I think there's 10 million people in LA County, and I think there's maybe a couple million up in Ventura. So yeah, being that as it is. Okay, so we got the rates in. I wanted to just talk now about housing and what is happening in the housing market. The HMI came out, that's a housing market index, and it's at 83. Now, everybody has been talking about the last 3 months that index has been going down. And when you read the immediacy of news, you forget to take into consideration the grand scheme of things, meaning that HMI number at its highest was 90, and that was last year. So between 90 and 83, yes, it has dropped, but it hasn't dropped that much. So housing is looking good. The builders index is high at 83, because they think, as I do, there's so much demand out there. It really doesn't matter all that much right now because the demand is so high, the interest rates are so low, and so therefore getting builders to build is, they have to be able to make money, especially the big builders, right? Shea and Pulte and Eli Broad and all these companies that are building large scale. I mean, they plan 10, 15 years in advance to get 5,000 houses in. But for the smaller builder who's still building up to, 10, 15 homes a year, or even the infill person who's building 2 or 3 homes a year, the demand is really high. And so therefore there's going to be a market for it. The questions of why isn't there more housing that we've talked about? And I think housing is the number one issue that we talk about on the show. Why is, I see we've got time here to go. Anyway, we'll pick it up in the next section. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks a lot for tuning into the show. We talk a lot about mortgages and what's going on in the real estate market. Everybody knows that rates are low and real estate is high. So those are the two main points, I guess, in any show, that if get right down to it, if you can afford something right now, it's a good time to buy. Equity in your home is rising currently at about 6 to 10%, which is unsustainable. But if you get in on it and the economy calms back down and you get to keep that equity, it's a good thing. One of the ways to get into the property or any property is in non-traditional ways. And I say non-traditional, meaning that not everybody is a cookie cutter loan. Not everybody is a W-2 employee of somebody who can verify everything and have an 850 FICO score. So for those people who aren't like that, how do they get into the market? How do they get advantaged to be able to get equity, raise their family's wealth? Because the number one way to raise wealth in the United States always has been, is really the house you live in or some investment property that you're going to buy. You pay it off, as 34% of the people in the US have paid off their house. And then you are sitting on, in most cases, $500,000 to $1 million. So yeah, that's a good thing. With us today to help us through some of this, tell us about what's going on in 2021, is Charles Giscombe from Malibu Funding. He's the, I guess you would say you were the liaison to more business, the director out there in Las Vegas, Nevada, and just an all-around terrific guy. Thanks, Chuck, for coming on the show.
Yeah, Happy New Year, and thank you guys for having me again. It's always a pleasure to be on the show.
Okay, so let's get into a little bit of some programs, some things that are happening this year, were happening last year, the expansion of some of the non-QM programs. What are you seeing is a solution for your borrowers?
Since COVID happened, and it's still occurring, obviously, when it first happened, starting in March, Jeff, when we first started seeing really the true effects of it, a lot of the programs that we had, the non-QM programs, started shutting down because they weren't sure what it was going to do to the market. Obviously, the economy was going to take a hit, and values that they thought at the time were going to go down. So what happened is that a lot of the lenders that we were dealing with had taken some of their programs and didn't necessarily shut them all down. Some of them did shut them down, but some of them lowered the LTV, so it wasn't as beneficial to a lot of borrowers to come in because they had to bring more money in. They could still transact, they just had to transact and bring a lot more cash to the table. Well, since then, since everything that's been happening, people have been more comfortable. The market stability has been occurring. The election has occurred. There's more stability now, which is why our interest rates are low right now. Like Jeff said, the values and the equity is going up, and you can get a really good interest rate on every deal now, especially a non-QM loan. So now I see a lot of these lenders coming back into the market and being more aggressive, even more aggressive than they were before the pandemic hit. They're being aggressive now because it's an opportunity. Individuals that have money still, are still liquid, have been able to maintain their credit, can really get out there aggressively, take advantage of the interest rates, and take advantage of these properties right now. It's a frenzy right now. A lot of the real estate agents and a lot of individuals are saying that there's not enough properties. It's jumping off the shelves, and they can't get their hands on enough. So that means that the market is going good. People are taking advantages of it. And these programs are a lot of the programs 40% of the loans that are being done right now are being done non-QM, which is astronomical. And with that
Yep.
being said, these programs are out there helping people get into the game.
Now, we know that most of these non-QM loans are purchased by investors. Now, the pool of investors for non-QM has to have gone up in order to have these kind of products be offered, or an expansion of products offered into the marketplace. Do you see that particular segment, those particular investors, because we're still running 9% default rate on non-QM since the pandemic. Now, regular loans are probably a little bit below that, but it doesn't seem to deter the investor, right?
No, Jeff, you know what? The investors have become more and more comfortable with this. And
Right.
because of these loans and the type of borrower that's going in, because you have to understand something. These borrowers are coming in and still showing that they have the ATR, which, in layman's terms, the ability to repay.
Right.
And when you can provide the ability to repay and you can meet that FICO score requirement, they're understanding that individuals have the money and will pay. And so now what they're doing is they're taking their risk factor that was way up through the roof. They're taking it now down, and it's becoming comparable. Not exactly parallel to where we are with traditional loans, but getting close as far as the rates is concerned, as far as the will in which they're comfortable to deal with. And so it makes it a very, very good loan to get into, which makes these investors more secure in taking these loans and becoming more aggressive, because there's a whole market of individuals that need this type of loan and that can qualify for it.
You know, why is it that people wait until the last minute to do a refi? We've had rates lower than they are now. Rates are a bit higher than they were off their lows, and my prediction is they will probably go up and continue to go up slowly, but we might see 3.5% by the end of the year, which is not a lot, but it's not 2.5%. Why do people wait? I don't understand that. Is it just they're lazy, or they don't trust, or what's the reason behind that?
You know, Jeff, I'm not Nostradamus or Chuckadamus.
Chuckadamus.
The fear that has been created for the last years with the country, politics has played a role in it. The market fluctuation has played a role in it. And a lot of times, individuals that are not doing this every day, they only see what they see. When they see the television and they see what's going on in the news, Jeff, it creates fear. And it creates fear all across the board for everything they're doing. It could be just as simple as, how much toilet paper do I buy, right?
Mm-hmm.
How many paper towels do I need, right? And how much canned food can I have? All the way down to the fact of, I don't want to do anything with my rate now because I don't know what's going on with the country. I don't know what's going to happen with the interest rates. And that fear sets a precedence across the board. So I believe that a lot of times people want to jump in, but they're afraid because they believe that, hey, listen, if the market goes crazy, I might get stuck in here. My house is not going to be up to this value. My interest rate's going to be crazy. So they just want to see true stability. And most people just follow the trends of other individuals, Jeff. I won't say that they're lazy because everyone wants to make money. I think more it's fear. And it's our job, and I like to say I love Malibu Funding and, Jeff, the environment that you create with everybody on our team that allows us to take the time out to explain and to teach these individuals about this process so that they can have more comfort and less fear in getting involved, knowing that we will guide them or suggest them in the right direction so that they can make intelligent decisions for themselves and the family for now and the future.
You know, I've had a lot of discussions with realtors, and towards the end of any cycle, there's a tension that builds, whether it's lack of inventory or other reasons. The loans are harder to get, and I sense a little bit of that now. Maybe it's because the inventory is so low. How do we solve that problem? And because rates are so low, we've certainly got a steady flow of borrowers.
We actually do, Jeff. We have a lot of borrowers that are ready to transact, and I like to, and that's a true testament of what we do. And I think that's across the board for all mortgages, but especially for Malibu, we've done a great job of keeping our borrowers informed. And so with that being said, you just have to touch base. I mean, one good thing, greatest thing about Malibu Funding is we're a real estate company too, Jeff. We have access to real estate, and we do a lot of business that way. And so we understand the market. We understand what it is to get involved in investments. We understand that we can get to these different properties, and it's just constantly keeping informed and having an individual that keeps their eyes out for you to find out the great investments. A lot of times, people are just grabbing everything right now because the interest rates are so low. They might not even be the best investments, Jeff, but in future, if the value goes up and they can buy really low, and it's a win for them. So it's just a matter of getting somebody that's going to constantly stay in front of you, put numbers in front of you so that you can take a look at. I mean, that's the only thing that I see. And also, there's new construction loans. Hell, Jeff, non-QM loans can provide new construction loans for you as well, which is another thing that you can get into. You can renovate a loan, a house that's not so good, or you can do construction. Non-QM loans provide those options as well.
Hey, Chuck, shout out your phone number for people who need a terrific loan officer. Chuck's office is out in Las Vegas, Nevada, where he's the qualified individual manager out there. But you do loans all over. If you could give a way for people to get in touch with you, that'd be great.
Absolutely, Jeff. My number is 702-328-5191, Las Vegas, 702-328-5191, or you can reach me at charles@malibufunding.biz. That's charles@malibufunding.boy, Isaac Zenith.
Chuck, thanks very much. Once again, great information, and really appreciate it. And we'll get you back soon because it's ever evolving and it's exciting new administration. So we'll see what happens on the economic front.
Jeff, thank you so much. I love to do it. I love to be here. And if we can help, I'm here for it.
Thank you very much. That's Charles Giscombe from Malibu Funding, Las Vegas. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks a lot for tuning into the show. We're on each and every week. We're on 8 major podcasts. We're on 5 stations, 3 different states. YouTube, Jeff Barton, the Mortgage Voice. We've got blog, bartonblog.com. I don't know, a whole bunch of other stuff. I ran out of steam on that stuff. Anyway, I bring to the show again, Luke Mankey, who's been with us many, many times. And I bring him back because of all the people I bring on the show, very few have a handle on exactly not only how to suss out what a client wants, but also to have the answers available because of his research and everything else he knows in the business to be able to help and answer the questions. Luke, how are you?
I'm doing pretty good, Jeff. I'm good, thank you. How are you doing?
I'm fine, thank you. And I appreciate you both coming on the show. But also, when I send you a client or somebody that needs some help, you're just right on it. You're there and, it may take you a day or so, but you come back with great scenarios and options for people to be able to see, oh, wow, this guy, he knows what he's doing, and he also is giving me some options. And you may not get every loan, but that kind of detail is really, really what separates you from other loan officers, and I appreciate that.
Thank you. Yeah, no, I think so. I believe knowledge is power, and people making informed decisions. It's a lot better doing it earlier on than giving them just a little bit of info, maybe not as much as they needed. Then you got a problem on your hands 3 weeks later, and we're in escrow, and we got other problems. It's just invaluable to be as thorough up front as you possibly can. I think at least that's the way I like to work.
Okay, so in a real estate deal, you find yourself behind the 8 ball because it's not a refi, you're dealing with other people, right? You've got 2 different real estate agents who want you to close that loan yesterday, and you've got a number of other concerns because you got a contract, you've got dates in the contract you got to abide by. So how do you avoid problems? I think you told me, but tell me again, what's the best way to avoid problems during an escrow with your client or with all these other people that you got to talk to?
Yeah, I mean, communication for one, having the right relationships and choosing the right lenders with the service levels that you need, that you really have to have in this, especially in a purchase transaction. Like, you got to be able to do that because there's definitely variables and people that you don't have control over, or you have limited control over. You got escrow and title agents that you don't choose, you don't work with, the sellers choose, and so you got to cultivate that relationship, make sure they're on ball, on the point, and if they're not, then you got to maybe work a little bit more efficiently just to make up for them lagging on certain things. and then just, advising, and sometimes you got realtors that are great and experienced, and other times you're advising them and telling them and calming them when they've got, maybe they've got concerns of if there are delays, and
Right.
there were
Right. That.
what happens if they get served a notice to perform, like all those things. There's just so many
Right.
things that kind of navigate around.
Yeah, I think when you deal with an experienced agent comes, okay, I mean, we're all trying to work together to try to close this. Everybody wants to, get it done for the borrower, for the seller, and for yourself, because this is what you do for a living. So nobody's dragging their feet. But most agents don't understand the process. And so how do you deal with them? Do you deal with them? I know some loan officers don't talk to realtors at all, and they make the real estate agent do it all. How do you handle that?
Man, I'll get as involved as I can, just because, well, naturally, as you said, you want to see it through. I mean, we get paid if we do our job, so yeah,
Right.
the money's nice, but it's in me to, like, I gotta see things through. I had a purchase transaction with a client recently that the realtor was just the worst and would not call anyone back. No communication with. Basically, just got everyone into escrow and then just like punted it and said, "All right, I'm not going to call anyone back." And it was a pain in the butt. And there ended up being a tenant in the it was an owner-occupied sale that had a tenant in the property that nobody was aware of until the final walkthrough.
Oh,
And
man.
we had to scramble, and you know how California is, how difficult it is to get renters out, especially
Yep.
during COVID. So we had to do that, and then I had an issue with liens and clouds on title that, again, the listing agent wasn't dealing with, and escrow was trying to do it, and then I got involved, and escrow was already upset at everyone, and I said, look, I'm trying to, like, let me come in and help, and she took a deep breath, and she's like, I can't say I've ever had the loan officer for the buyers trying to help out the sellers of the property to
Right.
get some issues on title and get payoff demands. It was like, they had a loan, a second that was sold from a company that closed and was serviced.
Yeah.
The servicer didn't have any paperwork, and oh man, it was a big nightmare. But we got involved and we found a way and made it happen and closed the deal, and everybody's happy. So
Creative Solutions
I don't know if that
basically is
a scenario of like how much we have to get involved sometimes with these realtors, I think.
Yeah, no, I as I was just interrupting you, sorry about that, but Creative Solutions is really what you need is somebody who has the knowledge, sure, but who wants to get involved and get down into the weeds sometimes in order to solve a problem, problems that you're talking about either on title or other issues that come up in a loan. They don't come up on every loan, but when they do come up, you need somebody who's willing to do the work, and that's a problem in a very busy market. A lot of people aren't willing to, especially a seller's market, where the real estate agent just kind of puts property on the market, some of them, and just that's it, they're done.
Yeah. Yeah, it's frustrating because they can get away with it because they know
Right.
15 other people lining up that are frothing to get the house.
Right.
All right, I'm not giving you any credit for all these inspection issues, and I'm not going to help you with anything, and take it or leave it. And I don't have to do my job. I'm still going to get paid. So,
Luke, do you find that going through COVID and the problems that we've had with forbearance and some of the other things that have prevented mortgages from being paid and rent from getting paid, do you think it's being handled differently and better than, let's say, in 2008 when we had those issues with obviously foreclosures and loan modifications? It just seems to me that this time seems a lot smoother.
that absolutely.
Looking for housing, is looking for new product, looking for foreclosed product. I don't think that product is coming. And I think whatever is owed, they'll pick up what they can and start paying again and work out what they're owed either by tacking it on the back end or adding a little bit of payment each month to the current mortgage. What's your thought on that?
I hope so. I hope that's what happens because, yeah, if it doesn't, then you're right. There's going to be some, there will be problems in maybe 6 to 18 months. It's going to be more than 6 months. But yeah, it's going to be a while down the line if they don't do that, if they don't work with them. And I hope they do. I mean, we don't need another mass, foreclosure, short sale, all these NODs everywhere and all these,
Right.
certain areas and cities will be fine. But then you got others that could be hard hit if we don't, we meaning, I guess, the government doesn't work with them to kind of create a way, like you say, tack on what was in forbearance and tack it onto the back and just make it work.
Right.
And it does. I mean, you're right. I think everything is definitely being handled. It's good. I mean, it was only 10, 12 years from that '08, so it's still fresh in everyone's memory, I think.
Yeah, I agree.
And so it's good to see the progress.
Well, we see servicing is better. It's more regulated. We see the lenders being much more willing to be able to help out. The forbearance requirement, and we've just got that extension, second day of Biden's office. I guess he extended the forbearance as well as the rent evictions to September, which I think is a good thing. I think that'll actually be when this thing calms down somewhat.
Yeah, everything opens back up. Yeah.
Hey, Luke, shout out your phone number for somebody who needs a terrific person who can help solve problems and be a great loan officer, if you would.
Thank you. Yeah, my phone number is 818-209-2592, and email is Luke, luke.malibufunding@yahoo.com.
And Luke does loans not only here in California, but has a big family up in Washington. So anybody who's got some loans up there, give him a call. Thanks, Luke.
Yes, sir. Thank you, guys.
Thank you. That's Luke Meeking from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening, watching us, wherever you do. We are on a number of radio stations. We're on the Big 8 podcast, YouTube, if you want to go there and see the show. We do a LinkedIn and Facebook show on a weekly, and so we're everywhere that you want to be. It's kind of like MasterCard, right? Again, Jeff Barton, thanks for tuning in. And if you do go to any of these places, click on that you like it. Join the show. The more the merrier. It helps us get to more people. And, we want to grow our base so that we can get the show into more markets. In order to do that, we just have to get more people to like what we're doing. So thank you very much. We've been talking to all of our guests today about the non-QM space, what that is and what it means. I listened today. There's a conference. I think it's called LIN. Anyway, it dealt a lot and deals a lot with the non-QM, the non-traditional type of loan that isn't backed by Freddie Mac or Fannie Mae. And in talking, listening to them, because you can't really talk, you can type in your questions. But I do like these events because I'm at my house and I'm looking like everybody is on the Zoom meeting and getting a lot from it. It was interesting to hear that since 2017, that the non-QM space has doubled every year since then. It started out as a what does it say? A $7 to $10 billion market, and today, well, it's 5 years later, times two. So you've probably got $100 to $150 billion market, and that's just this particular company. So this is big, right? And our guest Charles Giscombe on the show told us that non-QM is about 40% of the market now. So of all the loans out there, and we did approximately $3.2 trillion in loans last year. That's a big number, right? Think about that for a second. $3.2 trillion in loans, 40% of that, $1 trillion, let's say, is non-QM. So who's buying it? Why isn't more people doing it? Or what is the issue with it in terms of why isn't the federal government backing it if all these other private companies are? I think we're going to get back to privatization of Fannie and Freddie, maybe not right away during the Biden administration, but it's really in the best interest of the economy to be able to open up investment in Fannie and Freddie to continual investment of outside sources in order to monetize what they're doing. Certainly selling mortgage-backed securities, yes, they're doing that, and they're able to keep the Treasury sweep that was happening for forever, really. Obama administration started it and continued during Trump, whereby every quarter the profits made by Fannie Mae and Freddie Mac were swept into the Treasury. That has stopped in order to maintain or to make sure that the capitalization of Freddie Mac and Fannie Mae gets to the level. I think it's 4% of what they have in their portfolio. Now, their portfolios are huge. trillions of dollars are worth, right? So 4% of $1 trillion is what, 400 billion? Well, that's a big number. If it's 3 trillion or 6 trillion or whatever it is in their portfolio, what happens is the loans that are out there in the marketplace get bought by Fannie Mae or Freddie Mac in the qualified loan area. Those are then bundled together. Like if you have a number of loans that are getting 3% and you are offering an investor 1%, that means that, they have a secured 1% backed by the US government type of loan in a scenario whereby in investments all over the world, you can't get that type of return. So that's what's happening. That's how we securitize. That's how they get their money. All those pools of loans, and they call them pools of loans. If let's say that 3%, all the 3% done in November are put together in a package and they're selling at 1% coupon, which means that the yield is 1%. Okay, so those particular loans get refied on average every 7 to 10 years, some even quicker. So what happens to the investment portfolio, those pool of loans in the mortgage-backed security when the loans start refining out? These are always issues and have been an issue in the non-QM space more than, let's say, in Freddie Mac, Fannie Mae world. Even non-QM loans get packaged and sold on the secondary market in order to capitalize the non-QM space or give return to the investor. Now, the return to the investor on a pool of 3% loans in non-QM is going to be a lot higher than it is in Fannie Mae and Freddie Mac. And that is because the risk that they're taking on is less, right? What is the risk? Well, if you've got a Fannie Mae loan at 20% down purchase and the 800 FICO score, and they've got the ability to repay in a year W-2 job that they've had for 20 years, that's a pretty risk-free person making that borrow. However, if in the pool of loans at 3% in the non-QM space, right, if that borrower is a business owner who owns a restaurant in Albuquerque, New Mexico, which during COVID isn't doing so well, but they want to refi that and take some cash out because the property's worth something, what's the risk on that type of loan? Well, it's going to be a lot higher. Why? Because the guy's business is bad or the gal's business is bad. They have more of a risk. Therefore, you as a lender are going to want to see a lot of things. You're going to want to see the FICO score. You want to see their ability to repay beyond. You want to see less cash out or maybe just a rate and term refi. Now, all these buzzwords and things that I've been talking about are pretty straightforward in terms of what we need in the loan business when we're talking about funds to give you when you're looking for that loan, whether it's non-QM, whether it's qualified mortgage. But the non-QM is a huge market. It's going to be growing. And in terms of making sure that you have that ability to repay, that's still a very, very crucial part of what underwriters and people who assess risk are looking at. Obviously, more documentation is better. Now, we're going into a part of what QM and non-QM and what's the final compensation rule, all of these things that I hate policy. I really don't like budgetary processes, government, the way they work and how staff, quote unquote, comes up with the regulatory items in each law that is passed by whatever municipality, state, federal government does it. It's long, involved, and boring. And most of the time, what we look for is somebody to get in trouble first, and then we can say, okay, I'm not going to do that. But to get into the weeds and really figure out what it is that's needed, that's the issue with a lot of what goes on in the non-QM space. Because assessing risk is really about the programs and what guidelines are available in those programs, assessing the programs for their risk, and then saying, okay, you don't quite meet the program, so we're going to either charge you more or ask for more documentation. And that's what goes on in that particular world. In the world whereby, and let's talk about these four companies, right? Rocket Mortgage TPO, which used to be Quicken, United Wholesale Mortgage, Home Point, and Lensure. These four large mortgage companies have all decided to go into the public for money. They're going to be public corporations, and they're going to do it in 2021. So why do companies do that? Is it good for you? And what is the assessed risk for their product they offer based on the fact that they're public rather than private companies? All of these things are taking into consideration where the economy is headed, where those companies are headed. And if you're going into the public space in order to get paid or to expand your business, you have great confidence in what you're doing and in the marketplace. So in terms of mortgages, the rates where they are, and the business moving forward, these companies have decided to do that. And I'm not sure it's great for the consumer, but I'm not sure it's not great for the consumer. And the reasons are, if they're banking that their companies will perform in the public space, in order to get that kind of scrutiny on you, that means they must be bullish on what's happening in the mortgage market this year. And I think this year, for the next 10 years, as I said, I think we're going to see a building boom. I think we're going to see house prices stabilize, but continue to go up. And I think all of these things are good if we can maintain rates where they are. And we know from what the Fed said, through 2022, probably going to see rates remain pretty low. Really appreciate you listening to the show. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Okay. Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, for listening each and every week, and seeing us, whether it's on the feed at KMET or KCAA. By the way, we just upped another year for both of those stations. So I want to thank Fred, and I want to thank Bill, and all the other station owners that we are associated with, whether it's down in Albuquerque, up in Lake Tahoe, or in Las Vegas, Nevada. Thank you to everyone who's associated with the show. We love bringing information to people who want to buy a house, who want to refi a house, who are looking into the market to see where they can take advantage and if they can afford things. We don't want to get people into anything they can't afford. I attended a conference, online conference today, about affordability in certain segments of the market. This is the non-QM space. Now, the non-QM space, for everybody who doesn't know, let's say that you are a person who has their own business and you want to get a loan, but you don't show a lot on your taxes that you pay yourself, but you do write off on your business, like your car, your rent, and a bunch of other things. Those are the type of loans, business bank statement loans, that is considered non-QM. It's a loan that both Fannie Mae and Freddie Mac won't buy. And those are the government GSEs. Actually, they're really owned by, or 80% of it is owned by Uncle Sam when they bailed him out back in 2008. There's so much wrapped up in what's going on today that relates back to what happened in 2008 and what happened with Dodd-Frank and what happened with how we had servicers look at borrowers. The rules have changed in terms of the government stepping in quickly this time, creating a situation whereby the mortgage holder didn't have to pay their mortgage for a while if they got laid off. That was quite different than what it was back in 2008. In 2008, you were on your own. And so we had a lot more activity in the forbearance, not only forbearance, but in the loan mod area. And there came a lot of fraud in the loan mod area. And we call it loan mod, it's loan modification. Now, there are loan modifications today, but they are regulated much more heavily, as is the servicing, with the moratorium in place. It's a better scenario. And as a result of having a better scenario, you, the borrower, are protected more, the mortgage holder. Now, the people who rent, you too have a moratorium, and that's a good thing as well, I think, because if you lost your job, it's through no fault of your own, the government stepped in. And all of this has to relate back to, again, what happened in 2008. Reverse on that, what happened in 2008 when housing hit rock bottom in many markets? Large corporations came in, bought the houses, and then rented them out. By renting them out, they kept houses off the real estate market. And so since 2008, 9, 10, we've had a real low inventory. Now, what does that do? It keeps prices high. So the protection in the marketplace of price of houses has been really because there's been low inventory. We deal with that today when we say, okay, if you have a interest rate that's low, you will have low inventory. Why? Because more people can afford it, more people will be out there buying, and that also protects the price of the house because the scarcity of product, high demand because of low interest rates means that obviously the prices go up. We're going to see a 10% rise, according to who is this guy? There's so much information here. A guy named Mike Simpson at Altos Real Estate, another place that you can go to get some information on both real estate and mortgages. But he says we're looking at a 10% rise. Now, last year we had about a 6% rise in the price of homes, and that bodes very well. 34% of the homes out there are owned outright. Most people who get wealthy in America do it through real estate. Most families do it through their own home that eventually gets paid off, and there's this huge amount of equity in the home. And that huge amount of equity, plus the fact that we've had these lessons from '08, have really made the landing. Now, I'm not talking about the 11 to 15 million people out of work. That's terrible. And I'm not talking about people who are obviously grieving loved ones who have died, or the people who have died themselves. It's a horrible situation. But in terms of economics and the economy, it is not as bad as a lot of economists predicted. Now, what does that mean? It means that when COVID gets under control, are we looking at this month? No, we're probably looking at closer to August, September, when you can rest assured that the economy is back to where we can see that we've got 4 to 5%. Some people are predicting 6 to 10%, but I don't think so. Growth rate, which even during the expansion from Obama through Trump, we never really saw a 4%, maybe one quarter with Donald Trump after the tax cut. But that kind of growth is because people will begin to be spending money without the fear of needing to save. Now, during the COVID crisis, we all know that we've had, 33% savings rate, which is a good thing. Another thing that has bolstered the economy. It has made the equity in your home and the savings that people have in their bank accounts has really buoyed those who still are working and those who still have mortgages that they can pay. That's a good thing. Now, the housing market, as I said, has been booming simply because there's low inventory and the rates are low. And that's kind of the way it is. So getting back to the housing index and where we're heading, that's why we see this number 83, even though it's gone down 3 months in a row, is still a pretty high number, because we think, and I think personally, that building will probably be good for the next decade, because that's how far behind in housing we are. And we've got the biggest group of people wanting to buy a house that's ever happened. This millennial group, millennial Gen X crowd. And they're all out there right now looking for houses and wanting to get a house. So if you're in that crowd, yes, I think we should see building. Now, we have some what they call headwinds, right? We have some problems in the building industry. And I think some of it has to do with COVID, and some of it has to do with the commodities that are way overpriced: lumber, wood. Most houses are stick built, they call, which is 2x4s and drywall and all the things that we see in every house when they're being built, especially on all the home shows that you see, whether it's fix or flip or any of these other ones. You see the raw wood. Well, the wood prices have really skyrocketed over the last year, and it has really added to the cost of housing. If you're saying between $30,000 to $50,000 average on a house on a single family unit, that's a big number, especially when you're considering that the other headwinds or the other problems that we see in the building is small towns, cities, municipalities, counties, those that regulate the permitting process have all upped their fees because they're hurting for money too, because their revenue isn't what it was. And so they need money, and therefore fees have gone up. Now, all of these things are really bad. Now, I've talked about the fee system and how we could not end, but certainly help in quite a bit, help a lot in fixing the problem of housing if we could get local governments to look at the real estate inventory within their own particular area, come to some agreeable sum that they could sell off some of the city or county or state-owned land and tie it up in such a way that the price to get this land is cheap. And then like it would be for a 55 and older home complex, they don't allow the prices to get too high because it's for older people, right? You've seen them before. There are a number of communities like that. I think all of that is a way to be able to help housing. Anyway, we're coming up against it. We've talked a lot about building and housing, some of the promise of the new administration coming in, and there's some problems with the new administration too. We'll get into that next time. I didn't get to everything I wanted to today, but thanks very much for listening. I'm Jeff Barton, your voice in the mortgage industry, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.